All right. How is everybody today? That's kind of pitiful. How is everybody today? Great. All right, good. All right. So I am back. I am at about 80%, which is pretty good. When you get old like me, you're happy with 80%, okay? That's 80. You don't expect 100% anymore. 80% strength is about all you can expect. Couple of things before we finish. We'll finish with chapter 2 today. One is, if you have not been bringing a calculator of some type to class, for the start of chapter 3, which should be Tuesday, please bring some type of calculator. Okay? I mean, it can be your phone. It can be just a regular calculator. You don't need a financial calculator yet. If you haven't purchased one, that will be with the beginning of chapter 5, which is still a ways away. But just some type of calculator. Also, I've sent out some job announcements, more specifically internship announcements recently. Sent one out Tuesday, and the internship is with the FDIC, the Federal Deposit Insurance Corporation. And they have insurance. I mean, they have internship locations basically all over the United States. Now, I've had some students in the past do this. Most of those students have had a permanent job offer after the internship. And if you look at the pay of the internship, the pay is really good for an internship job. It's essentially a 6-month, and there's so many hours associated with it. So the way it works is, typically it's a summer internship. But if you don't get all of your hours in during the summer, then they will let you go back and work. Typically, if you've got a long weekend, for example, you can go back. The Christmas break, if you need some days then. So it pays you enough that if you don't live in that area, you earn enough money to rent an apartment, get some really good experience, make some money, and get possibly a permanent job offer when you're finished. I've probably had maybe 4 students go through that. So if you are interested, if you have more questions, the application deadline for that is tomorrow. And you need a letter of reference from a professor. So if you're planning on using either me or another professor for a letter of reference, we're notoriously slow in getting those out. So you need to let us know really quickly. Also, I will post later today a permanent job opportunity for any of you who may be graduating in May. It is with the Office of the Comptroller of the Currency. It's a similar job to the FDIC. The only difference is the FDIC examines state chartered banks. The OCC examines nationally chartered banks. So a little bit bigger financial institutions. Again, a really good opportunity. I've got several students working for the OCC. I myself worked for the OCC at one time. And the starting salary, base starting salary for the OCC is $50,000. And then you have some geographic pay differentials. So for example, if you're that's the average cost of living, $50,000 is what they'll pay you. If you go to what they call a high cost of living area, for example, when I worked in Atlanta, there was like a 4% pay differential, so I got 4% in addition to the starting salary. If you go to New York City, the pay differential may be 40%. If you go to San Francisco, the pay differential may be 80%. You may get 80% more than the starting salary. So again, it just depends on where you work. But I'll post that later, hopefully later today or tomorrow. And those applications aren't due until February 8th, I think, maybe, something like that. But what you'll find is most of these government agencies have a very narrow window in which you can apply. And outside of that window, they don't accept applications. So you have to put your application in. Even if you're not really sure, you might want to go ahead and get your application in. What else? Another thing is I'm working on the sound. I've been getting some complaints, well-deserved complaints, about the sound quality with the Tegrity video. So I'm trying different things. You probably just heard a lot of static because I touched the microphone. But I'm trying different ways to position the microphone. I'm also getting some feedback from the receiver. Now, of course, this is not a very expensive setup, so it's not going to be professional sound quality. This is just what Murray State gives me to record these lectures. But I'm keeping the receiver away from the equipment. That could be they have to be getting some feedback, some interference from that. So we'll see. If you have a chance to listen to the recordings, let me know what you think of the sound quality. What else? Let me ask you, any questions? I've had a few people ask about homework questions, of course, on the Canvas page. As I mentioned, probably the first class. There are, where are we here? On the Canvas homepage, the second item down, chapter practice questions and solutions, so you can click on that. I do not take those up, okay? I don't take up your homework questions. Also, I've had some people ask me about these quizzes, and some of the quizzes, when you look at some of the quiz dates, especially if you're in the online class or the test dates, it will say May 1st. And a couple of people said, hey, are we having all of our tests May 1st? No, we're not having all of our tests on May 1st. It's just that I've set them at May 1st so that students don't have access to them yet. But whenever we do know, for example, the first test date in the in-person class, I will let you know well in advance. I'll probably let you vote on it, actually. Give you a couple of options and let you vote on the test date. And if you're in the online class, again, I will give you plenty of advance notice, and we'll let you know the test open date and the test close date. And that's usually a pretty generous window for you to take the test. All right. So no questions? You're just happy to be here? What? Been a slow day? Yeah, I've got to be here till 9 o'clock tonight, too. Golly. Bad day for me. All right. Let's go ahead, and if you think it's been a slow day so far, wait till we get to the lecture today, okay? Because we get to open up, I think we left off here with financial markets, so we get to open up today, this slow day, with corporate taxes. So I will not interrupt your slow day, okay? We'll keep it there. All right, so now let me remind you that in chapter 2 we're talking about the environment in which a corporation operates. And so we've talked about things such as financial institutions. Of course, financial institutions, some of them are corporations, but we're talking about, non-financial corporations have to deal with financial institutions like banks, insurance companies, mutual funds, retirement plans, pension funds, etc., on a daily basis. Also, we talked about financial markets, and corporations have to deal with financial markets on a daily basis. We're going to spend just a few minutes talking about corporate income tax because corporations have to deal with taxes. And, of course, this is tax season. What a wonderful time of year. So some of you are very familiar with paying taxes. How many people in here have had the pleasure of paying personal income tax? Raise your hand. So if you've ever had a job, basically, then you have paid a personal corporate income tax. Now, it's kind of a shocker. The first time, I remember my first job I ever had. Part-time job. I was a teenager. I had worked my first week. I was making minimum wage. And I'd gone through probably 10 different times calculating, okay, so many hours times so much per hour. I'm going to have, this much money to spend this weekend. And I was so excited, and when I got my first check, because again, when you go to work, typically they'll withhold, they'll hold back the first week's check, and so you don't get paid for a while. But I got my first check, and I looked at it, and it wasn't as much as I thought it was going to be. and they had all this other stuff on my check. Like, what are some of the other things that you will see on your paycheck when you get it on your pay stub? State taxes that they took out. If you live in a state like Kentucky with a state income tax. Now, if you live in Tennessee, working Tennessee, they do not have a state income tax. Federal income tax, they take that out. Social Security. What else? Medicare or Medicaid, Medicare. Sometimes city taxes. If you have a local income tax, yes, they will take that out. I mean, all that stuff comes out, and then you get what's called your net pay, your net income. Okay? And that is your income after taxes and all other deductions have been taken out. And typically it is much less than what you thought you were going to make, your gross income. Now, when you are in a lower tax bracket, it's not quite as painful. But in the United States, just like in a lot of other countries, we have what's called a progressive income tax system. Okay? So it says there corporations like individuals pay income tax, and we have a progressive income tax system for corporations and individuals. Now, what that simply means is the more money you make, whether you're an individual or a corporation, the more money you make, the percentage of your income they take out in taxes. Well, the larger your percentage you pay in taxes. So if you make $10,000 per year, percentage-wise, you're going to pay less than if you make $50,000. And you'll pay less than if you made $100,000. So it's the same way with individuals and corporations. Now, there are some other possible tax systems. We said we have a progressive tax system. That's what we're dealing with now. That's what we've had for a very, very long time. What other type of tax systems are there? A regressive tax system, okay? A regressive tax system, and this is a very hypothetical situation, but with the regressive tax system, the more money you make, the lower the percentage of your income you're going to pay in taxes. I'll just go ahead and tell you right now, I'll make this blanket statement. We will never have a regressive tax system. I can only wish, but we will never have a regressive tax system. Okay? What other options do we have? A flat tax. Okay, and a flat tax system, and you hear that pop up from time to time, typically around presidential elections, because most of the time there's a presidential candidate running on a flat tax platform, and what that simply means is everybody pays the same percentage of their income in taxes. So maybe it's 10%. So whether you make $10,000, $50,000, $250,000, you're just going to pay 10% of your income, nice and easy, and that's what's called a flat tax system. Now, a flat tax system for individuals or corporations, it has some merits. I mean, it simplifies things. Instead of having the IRS and an just incredibly complicated tax code. And some of you, has anybody in here ever filled out your own income tax return? So some of you have, okay. And if you're filling out what's called a 1040-EZ, I mean, it's pretty straightforward, okay? It should take you probably, once you've done one or two, it should take you probably 10 minutes or less. If you're filling out the long form, it takes a little longer. I fill out my own taxes. I do my own taxes. I've always done them. And when you first start, it's pretty simple, and then things get more complicated. You have tax deductions that you're dealing with. If you have a business and you have business expenses, business income, maybe you have rental property, maybe you have two businesses, and so you got to deal with depreciation, which we'll talk about some in Chapter 4. I mean, it just gets a lot more complicated. So, I'm not the smartest person in the world, but I'm pretty good with numbers and understanding things. And, I sit down and struggle every year with my income tax this time of year. Would it be easier for me to just turn it over to a CPA and say, here, calculate my taxes? Yeah, it would. But I'm just not that kind of person. Okay, I'm not saying it's right. I'm just saying I'm not that kind of person. So I like to figure stuff out. So I'm the kind of person who will change the oil in his car. You know, I'm just that kind of person. So I like to do my own taxes. But again, really, really complicated. So a flat tax system will be simply, you make X number of dollars, you pay 10%, you're finished. No deductions, no anything. Just really, really simple. But let's go back to the progressive tax system, because that's what we have. That's what we have to deal with. And that's what corporations and individuals have to deal with. Now, typically, I can get some pretty good bantering, I guess would be the word, between students regarding the fairness or the unfairness of a progressive tax system. Because again, let me remind you, a progressive tax system means the more money you make, the larger the percentage of your income you pay in taxes. Now, my question is that a fair tax system? And typically somebody, you know, there's at least a few people who have a really strong opinion one way or the other in terms of, is that fair? So give me your opinion. You can't be wrong here. It's just your opinion. So is it fair? Okay. Go explain that. Okay, that's good. That's good. Does anybody want to add to that argument? Fair, unfair. And the reason that this is important, and the reason that I take a little bit of time to talk about this from a personal income tax perspective, is because most of you are not going to be CPA. Okay, most of you are not going to be professional tax preparers. But all of you, if you have a job, are going to be paying income tax. So even if you're not an accountant, you at least need to understand the type of tax system we have, because you're the ones who are electing representatives who are going to Washington, who are setting tax policy by which you have to abide. So you need to have at least an opinion on this. Yes, it's good. No, it's not good. It's fair. It's unfair. Whatever. You have to have an opinion because you're electing the people to Washington who are setting these tax policies. Yes, sir. Okay, so the extremely rich don't pay as much. Okay, so that's a very valid argument. What he's saying is that extremely wealthy people, they have, tax attorneys, they have accountants that can find loopholes, that can find ways around paying taxes. And so, I'm not saying that's right or wrong. I'm just saying that's a very real possibility. That's a very good argument. What, somebody else? Okay, so people who have been very successful, you're saying they've worked hard to get to that point, and a progressive tax system, I don't know if punish is the right word, but it penalizes them for being successful. Is that what you're saying? Okay, I'm just making sure that everybody in the online class can hear. Okay, okay. So good argument. What about? Are there any other contrasting points of view? Okay. Now, okay, the tax loopholes that you're referring to, what we call that is, the official term for that is tax avoidance. Okay? And there's a couple of terms that we'll be talking about in here. One is called tax avoidance. What that means is that you take all of the legal tax benefits that you're supposed to receive. You know, for example, if you have 6 kids, you can take a deduction for each of your children. You know, and that's just fair that you take a deduction for all 6 children. If you pay interest on a home mortgage, you can deduct that interest on your home mortgage. That's perfectly legal. So that's tax evasion. So what you're talking about, I mean, there's nothing illegal about it. Now, tax avoidance is legal. Tax evasion, on the other hand, that's what you're trying to stay away from. Okay? Tax evasion means you've got 1 child and you claim you have 6 children and you take 6 child deductions. Or you try to deduct your dog as a kid, or you know, you don't claim income that you've received. You're trying to hide income. That's tax evasion, and that's illegal, and that can get you into a lot of trouble in either penalties, jail time, those types of things. No, I'm not saying. I'm just saying that I just want to make sure that everybody understands that, you know, you need to know the difference between tax avoidance versus tax evasion. 2 very big differences. Okay. Is there anybody that was sort of an argument for a progressive tax system? Is there anybody in who thinks it's a really fair system? It's okay. You can talk. It's okay. I won't yell at you. Nobody else will yell at you. I will not let them. Okay. Do I have any ideas? Okay. In classes, I try to keep my personal opinions out of the class, okay? But I will give you the explanation for both sides, the traditional explanation. Okay. The explanation for the progressive tax system is that when it comes to living, there are certain things you have to have: food, shelter, clothing. And that takes up a certain dollar amount of your income. I mean, I don't care how cheap you shop. You still have to buy food, have to pay for shelter, have to have clothing. And so the argument is, for the progressive tax system, somebody who's making $15,000 per year, the majority or all of their income goes towards basic food, clothing, and shelter. And so they don't really have anything left over. They don't have any what's called disposable income. On the other hand, if you're making $115,000 per year, you still have to have food, clothing, and shelter. But since a smaller percentage of your budget goes to those basics of life, you have more money left over with which you can pay income tax. So, you know, you're making more money, but you have more disposable income, and you can pay a little more. You can pay a little more than maybe your fair share, because other people don't have as much. Okay, that's kind of the argument for progressive income tax system. The argument against the progressive tax system has been mentioned, and that is that it is seen by some as penalizing you for being successful. Now, here's an example. I've got 60 people in this class today on what was a beautiful sunny day. Now it's a cloudy Thursday afternoon. And I'm sure that there's no other place you would rather be than sitting in this class. Am I right? You can't think of any better place to be. But you're here. And you're going to be here hopefully most Tuesdays and Thursdays until May. Now, let's say you have some friends, you probably got some friends that you graduated from high school with, who decided that college just wasn't for them. And maybe they went to work for a local employer. Maybe you have a local factory that pays pretty good wages. And so they went to work right out of high school making $35,000, $40,000. Now, again, I don't know your personal financial situation, but if you're like I was when I was in college, you don't have just a ton of excess money. And so you're here for however many years you're here for, struggling, and your friends who are working, making a pretty good living, they've got new cars, boats, motorcycles, they're taking vacations, they maybe have bought a house, and you're not to that point yet. Now, the reason that you're here is, you're going to say, well, to have a better life. And having a better life doesn't always equate into making more money, okay? But you're here either to have a better life or because you couldn't think of anything better to do or you didn't want to go to work yet or whatever the situation might be. But when you graduate, hopefully you're going to be able to get a decent job, and then this college education is going to be your stepping stone to pay increases. So let's say you get a job starting at $40,000, $45,000 per year when you graduate, but then your pay goes to $55,000, $65,000, $85,000, $105,000, $150,000 per year. So let's say 10 years from now, you're making $100,000 per year. Your friend who you graduated from high school with, who's still at the factory, is still making roughly the equivalent of $35,000 to $40,000. They may get pay increases, but typically they're what's called cost of living increases. So it really doesn't improve your salary. It just keeps up with the pace of inflation. If you're making $100,000, you're going to be paying a higher percentage of your income in taxes than your buddy who's making $40,000. But you're making more money because you sat through a Principles of Finance class and lots of other classes for 4 years. So the argument is that a progressive income tax is penalizing you for working hard, for sacrificing, for being successful. Again, is it right or wrong? I mean, there really is no right or wrong. It's just that's what some people will argue. And if you're a doctor and you go to medical school, if you're a medical doctor, go to medical school and do your residencies and all of that, spend 10 years, 12 years in school, and you're making $500,000 per year, you're going to be paying a lot of income tax. And again, people will say that you're being penalized for being successful and for working hard. No right or wrong answer. It's just you need to have an opinion about this. Is it right? Is it wrong? I don't know. Now, so this is talking about, the pros and cons of a progressive tax system. And I'll come back to this in just a minute. We'll discuss this a little bit more. Now, we've been talking about personal income tax. We'll talk about corporations. They have a progressive tax system also. And we're going to be talking about two different types of income in here. So we're really simplifying things. One is what's called ordinary income. This is simply income earned through the sale of goods and services. The other is what's called a capital gain or a capital loss. And again, if you're an accounting major and you see this definition of a capital gain, which I'm saying that's simply when an asset is sold for more than its book value, you're going to say, whoa, wait a minute, that's not what we studied in my accounting classes, because with the capital gain, you've got recaptured depreciation, you've got, lots of other things that go into it. I'm simplifying. I'm just saying if you have an asset that is worth, well, let's take a step back here. Let's say that you just purchased a truck for your company, just a regular truck, for $30,000. That's a company truck. That's a company asset. So on your balance sheet, and we're going to get to this in the next chapter, you're going to have truck, $30,000 under assets. Now, since this is what's called a depreciable asset, which we'll talk about this in Chapter 4, you can depreciate the value of this truck each year. So let's say that 2 years go by, and you've taken $16,000 in depreciation. So you've had a truck of $30,000, you've taken $16,000 in depreciation, so your truck's book value, the amount on the balance sheet that that truck is worth, is 30 minus 16, or $14,000. So you're going to show truck, $14,000. But let's say that you decide to sell this truck. And you advertise it in the local paper. Keep in mind that book value, what something is worth on the balance sheet, and the actual market value sometimes are completely different. So let's say you advertise your $20,000 for sale. Somebody comes by and you negotiate a sale price of $18,000. So the book value is $14,000. The sale price is $18,000. So in this case, you have sold this asset for more than its book value, so you have a capital gain of $18,000 minus $14,000, or $4,000. And you have to pay tax on this capital gain. Does that make sense? Everybody follow me here? And again, we'll talk more about this in Chapter 3. And so, again, you can also have a capital loss if you sell an asset for less than its book value. That's a tax benefit, actually. But two different types of income: ordinary income, capital gain, or capital loss. And this is in your book. This is what's called a corporate tax table. Basically, what this is simply a quick way of calculating the taxes that a corporation would pay. In reality, it's much more complicated than this. But this is just a handy little tool for helping us. I will go ahead and tell you that on the first test, I will give you a couple of questions regarding calculating taxes using the corporate tax table. So it's not going to be a surprise. You know it's coming. You're also going to have a copy of this tax table, so you don't have to memorize any of these numbers. It'll be given to you. And in looking at the tax table, what we have here is we have essentially categories of income. So, for example, the first line here is if you have taxable income, a corporation, of $0 to $50,000, you're going to pay 15% of that income in tax. If you have $50,000 to $75,000 of income, the base that you're going to pay is $7,500 plus 25% times any amount over $50,000. And then it goes 75 to 100, 100 to 335, etc. And so we'll go through an example of this, of how to work a problem using the corporate tax table. But again, it's really straightforward, pretty simple. Okay. Now, here is an example. It says if your corporate net income, your taxable income, is $8 million, how do we calculate the taxes that you would pay? And so your tax is going to be, well, let's go back here for a minute. Okay, so $8 million, so you're going to fall within this category, $335,000 to $10 million of taxable income. So your base tax is going to be $113,900 plus 34% times any amount over $335,000. So if we go forward, this is our base tax, $113,900 plus 34% times any amount over $335,000. And so if we take the $8 million, subtract $335,000 from it, that leaves us with $7,765,000. If we take this amount, multiply it by 34%, which is what's called our marginal tax rate, that's going to leave us with $2,606,100 in taxes. And so if we add to this the original base amount of $113,900, which we're doing down here on the bottom line, it's going to leave us owing $2,720,000 in taxes on $8 million of taxable income. All right, now here's the question I'm afraid to ask. Does that make sense? It's a large chunk of money. It is. And we'll talk a little more about the total and what we call that in just a minute. But I want to make sure, do you understand where these numbers are coming from based on the tax table? I'm getting some yeses. Okay. There. All right. Let's work another problem just to make sure that you understand this. I'll let you work this one. Let's say that. So if you have a calculator, you need to take your calculator out. You're going to need it. Now, this is, in this class, of course, since I'm recording this for the online class, if I write something on the board, they can't see it. Okay? So I have my handy-dandy little bamboo here that I'm going to be writing on. The problem with this is, I don't know if you've ever done this before, but I'm looking at the computer screen in one place and I'm writing in another place. That's not really easy to do. My handwriting is bad enough if I'm looking at my handwriting as I'm doing on a piece of paper. When I'm trying to look one place and write someplace else, it's incredibly bad. Okay? So be patient with me, even though I've been using this for a while, be patient with me as I go through this. And so you'll be able to see what I'm writing as we go through this. I'll be able to put my numbers up here and I can write my name and all this stuff, But again, it's kind of difficult. So let's say that your corporation, and I put this here, I asked for an extension. It was a little bit short last semester because I couldn't really get it here. I had to have it over here. And so I asked for an extension. And so they found me an extension. So now I can take this thing. I don't know what they were thinking, but I can take it a long way. I don't think I need it this much. So if you see me tripping over something, I'm tripping over this cord up here as I'm walking around. All right. Let's say that your company makes $95,000 in corporate income. Okay? We'll make it a little bit easier, a little bit simpler. So they make $95,000 in taxable income. And what I want you to do is, using the table, calculate for me the income tax, using the tax table, that they would pay on $95,000 of taxable income. That should be fairly straightforward. Now let me go back. I'll take you back to the tax table here. Okay. So you can see the $95,000 is going to fit here, the $75,000 to $100,000 category. And so take just a couple of minutes, if you would, and calculate for me the tax that would be paid on $95,000 of taxable income. Okay, hold that number for just a minute. Okay, so let's see, that's 1370, 50, and 34%. All right, so I will work through this with you. Okay, it disappeared, but let me go ahead and put this back. Okay, so we had $95,000. Okay, now the base amount that we're going to pay on this is going to be $13,750 in taxes. And then we're going to pay, if we look at the $75,000 to $100,000 category, we're going to pay 34% times any amount over $75,000. So if we take $95,000 minus $75,000, that leaves us with $20,000. So we're going to take $20,000 times 34%, 0.34. And that should equal, if my math is correct, $6,800. And so now we're going to take our base amount of $13,750. We're going to add to that the $6,800, and that equals a total of how much? $20,550 in taxes that this company would pay. So they make $95,000. They're going to pay on that $95,000, $20,550 in federal income tax. Does everybody see? Are you clear where the numbers are coming from here? If you're not, that's fine. Just raise your hand. Let me know. I'll be happy to go back through any of this. Okay, so everybody's good with this. Okay, now what you see here, again, this is a calculation. You're going to see this on the test. And one of the terms that you're going to see in just a minute is what's called the average tax rate. And the average tax rate, I mean, it's not extremely useful, but it just gives us an idea of what percentage on average are we paying in terms of income tax. So if we wanted to calculate the average tax rate here, we would take the taxes that we're going to pay, which is $20,550, and divide that by our taxable income of $95,000. That's supposed to be a comma. And so $20,550 divided by $95,000 equals how much? Point what? 0.216. Okay, so 0.216. Find where I am here. 0.216 or 21.6%. So this company pays an average tax rate of 21.6%. Now, at this point, this reminds me of something that I want you to do, especially if you have one of the Texas Instruments BA2 Plus calculators. You have one of these. What I want you to do, or if you have another calculator and you can do this, I want you to change your decimals to 4 decimals. A lot of times, if you just bought the calculator, it's going to be set to 2 decimal places. Okay? Now, let me go through this with you. If you have one of these, I'll go through the process with you. The first thing you need to press if you want to change your decimal places, first of all, press your clear button and get back to showing all zeros. Now, typically, I have one of these that I can show on the screen. I just didn't bring it with me today, but I can walk you through this. Once you're showing all zeros, press your second button. Your second button is going to be on the left-hand side, probably the second row down. It's going to be white, yellow, or gray, depending on which model you have. Press the second key, and then press your decimal place key. It's going to be at the bottom row of keys, about the center of your calculator. And it should say on your screen, DEC equals, and it may say 2.00. We want to change it to 4. So press the number 4 key, and then press the Enter key that should be on the top row of keys. Once you do that, it should say DEC equals 4 point, and then 4 zeros. And then if you press your clear key after that, it should say 0 point and 4 zeros, and it will stay that way unless you go in and change it, which there's no need for you to change it the rest of the semester. Okay? And the reason for this is when we get to these percentages like this, what I like to do is we take it to 4 zeros, and then for this problem, for example, we would round to 2 decimal places. So if we do this again, set to 4 decimal places, the 2550 divided by 95,000, it probably says 21.2163. Okay, so 63. So we would round this to 21.63%. So does everybody get that done? If you didn't, I'll help you. I'll be happy to come by and help you get it set. And we'll have to go through this again once some of you buy your calculators, and that's fine, but I just want to make sure that you are changed to 4 decimal places. Okay, so that's the average tax rate. All right, so that's what we just calculated here, average tax rate. Now, you also have something called the marginal tax rate, and you need to know the definition of this because this is really useful for financial decision making. And essentially, the marginal tax rate, as we talked about in I think in chapter 1, when we talked about decisions are made on the margin, the marginal tax rate is the tax rate paid on each additional dollar of income. So each additional dollar of income that you make, you're going to pay a percentage of your income in taxes. Now, unlike the average tax rate, and again, this formula will be given to you on your formula sheet for the test, so you don't have to worry about memorizing that. But with the marginal tax rate, you don't even have to memorize a formula. Basically, your marginal tax rate is going to be these percentages in your table. Because this is the percentage of your income that you will pay on each additional dollar of income. For example, we calculated the tax on $95,000. But what if we made $95,001 of taxable income? What percentage of income would we pay on that additional dollar of income? What percent will we pay? I heard somebody say it, 34%. And if we made $95,002, what percentage of income are we going to pay on that additional dollar of income? 34%, up to what amount? Up to $100,000. And at that point, we're then going to jump up to a marginal tax rate of 39%. Okay? So you need to know the difference and how to calculate average tax rate, which is actually a formula, and marginal tax rate, which is simply looking at the tax table. Okay, a couple of other things about taxable income. One is interest. Now, this is for corporations, interest income versus dividend income. Interest income is what you receive when you own some type of debt instrument. So, if, for example, if a corporation owns government bonds, if it purchased government bonds, it's going to receive interest income from owning those government bonds. And the interest income that the corporation receives is going to be taxed fully at its ordinary tax rate. On the other hand, a corporation can own the stock or shares of stock of another corporation. And if you own shares of stock, you may receive what's called dividend income. So bonds pay interest, stocks pay dividends. And the great thing about dividend income for a corporation, if you meet certain requirements, is that 70% of dividend income is excluded from taxation, and the remaining 30% is taxed as ordinary income. So you get a 70% tax break if you receive dividends as a corporation. That's huge. I wish Murray State would say, hey, guess what? We're not going to tax you on 70% of your income. It would be a great year. Okay? Now, the question is, the bottom of the screen, why does the government allow corporations to receive this huge tax break on dividends and not necessarily on interest income? Are they just They're just being nice. The IRS just says, hey, we feel good today. We're going to let corporations not pay taxes on 70% of their dividend income. To cater to businesses, okay, or I'm going to change it just a little bit, to spur business growth or to entice businesses to invest in other businesses. That's why they allow this, because if one corporation, which corporations tend to have a lot of cash, they invest in another maybe smaller corporation, that corporation then has money that they can develop new products. They can conduct research and development. They can do a lot of things and grow. And if they grow, guess what? They're going to hire more people. And more people pay more personal income tax. So the government's not doing this just to be nice. They're doing it to spur economic growth. But you need to know this for the test. Know that dividends are 70% excluded from taxation if a corporation meets certain requirements. This is fairly straightforward. You don't have to know a lot about this. It's called a tax loss carryback and carry forward. Basically, what you need to know is the first bullet point here, where it says if a corporation has an operating loss, it can take the loss back up to 3 years and forward up to 20 years. Now, without getting too technical, the reason for this, you can see the bottom question on the slide, the reason for this, again, is the government has found it's cheaper to allow this than to not allow it. For example, let's say that we have a really bad year. The economy's in a recession, and a company, a small company, has a really bad year, and they lose a lot of money. It's not unusual for corporations to have negative earnings, which means their expenses exceed their income. Now, just to let you know, if you're filling out your own personal income tax, as an individual, you cannot have negative income. Don't try that with the IRS, okay? But as a corporation, you can only go down to zero as an individual. But as a corporation, you can have negative income. And so what this says is, if you have a loss 1 year, you can then go back up to 3 years, tax loss carryback, and you can recover some of the income taxes that you paid 3 years ago. And if the loss encompasses all of that, you can then go back 2 years and recover some of your taxes. Or you can go back 1 year and recover some of your taxes. And if you still have a loss left over, you can then start going forward up to 20 years. So this is a big benefit for a lot of companies. And what this does is it keeps a lot of companies from going bankrupt because of a big operating loss. So it's a pretty good thing for corporations. Okay, just some other things in the chapter, in chapter 2. It talks about, it talks about the SEC. Now, if you grew up in Tennessee or Kentucky or somewhere and you hear the letters SEC, you think of Southeastern Conference. Okay, when you hear me refer to the SEC, I'm not talking about the Southeastern Conference. I'm talking about the Securities and Exchange Commission. This is the police force for the investment world. They're the ones who look at insider trading. They're the ones who make, they look at stock scams, irregularities in corporations and how they're set up. I mean, they have a lot of power within the investing world. So essentially, you need to know what the Securities and Exchange Commission is and what they do. And then it talks about investment banks, and it goes into the investment banking process. So I'm going to let you read a lot of this on your own. But essentially, investment bankers, now, that's different than a commercial bank. We talked about commercial banks at the first part of Chapter 2. That's where you have a savings account or checking account, or you go to get a car loan or a business loan. investment bankers help corporations raise money through issuing stocks or bonds. So when a company wants to go public, for example, when Facebook wanted to go public, I mean, that's a pretty complicated process. You just don't wake up one morning as the CEO of Facebook and go, you know what? I've got all of my money tied up in Facebook. I own a lot of the stock, and a few other select individuals and companies may own the other part of the stock. But we want to go from what's called a privately held corporation to a publicly held corporation. So anybody can own the stock of Facebook. But that's a complicated process. And so you get investment bankers involved. They help you design the type of security you're going to issue. They help you set the price at which you're going to sell the stock or the bonds. And they help with the marketing. They find buyers, et cetera, et cetera. So they help to make the markets. And so this kind of walks you through that process of raising capital. That means selling stocks or bonds. You know, what kind of issue are you going to have? You're going to have a best efforts issue. Are you going to have an underwriter issue, that type of thing? You need to know these terms. Okay, what is an underwriting syndicate? What is a lead or managing underwriter? What is a selling group? Again, definitions, so we're not going to talk too much about those. And just one word there tends to confuse students is the word syndicate. A syndicate is simply a group of investment bankers. So instead of one investment bank getting together, if the deal's too big for one investment bank to handle, they're going to get a syndicate together or a group of investment banks, and they're going to split up the offering, 2 ways, 3 ways, 4 ways, 5 ways, whatever. And you're typically going to have one person or one investment banker that's the lead underwriter, and then the rest would simply fall under that with certain percentages of ownership. Shelf registration, this is in the investment banking process. This is when you register the sale of securities with the SEC, but you don't actually go through and sell those stocks or bonds yet. You just put them on the shelf and wait. A good reason for this might be, let's say that you're planning on offering some additional shares of stock in your company. So you need to raise excess capital or additional capital. But right now, your company's stock is selling at a pretty low price. And so you really don't want to sell the additional shares right now because the price is not that good. But you go ahead and file all the paperwork. You're going to issue 1 million additional shares, and you just put those on the shelf temporarily. In 6 months from now, the price of your stock has rebounded. It's gone back up. So now you decide it's a good time to sell, and so you essentially take these shares of stock off the shelf and sell them. And you make more money than you would have otherwise selling at a lower price. But this is called shelf registration. It simplifies the process just a little bit once you get all the paperwork filed. And then it talks about the investment banking process, international financial markets. So it goes into that. And really, it's become a world financial market. So whatever happens in one country typically will have an effect on most stock markets around the world. And goes into that. And finally, the end of chapter 2. So are there any questions about chapter 2? All right, if not, let me remind you, on Tuesday, you'll need a calculator of some type. We're going to be moving into chapter 3, so go ahead and be reading chapter 3 if you want to. Be sure to bring your calculator to class on Tuesday. Everybody have a great weekend. Stay safe, and I will see you back here next week.